All right. Hey everyone, Sofia here from eXp Realty Realtor. Been a realtor for, I don't know, 12 years or so, and like the work, but in a financial planning business for 35. So that brought me around the money business. The money business for me is really what my core work is, Palm Beach Prosperity Group, here located in Boca Raton, Florida. And so I'm here to share marketing strategies with you, be able to help you identify opportunities, ways to open more doors of conversation that lead to more real estate business, but also at the same time, be able to make more money for yourself and learn about wealth and wealth management. And so if you're on the right Zoom, this was the Zoom for becoming your own banker. Also, how to integrate that with real estate investing, not only for yourself, but also to educate investors, right? Because when we educate them, they turn to us for more information and want to work with us. So we need to share this information with them. And I think we got the right person today. And in fact, I know we do, and that's Stephen Nagy. He's part of the Money Multiplier team. He's much more than that. I think you're going to find him very energetic, exciting, and extremely knowledgeable with blending real estate in with the world of becoming your own banker. And I could say a lot more, but I'll let Stephen just talk about who he is a little bit, and then he has a presentation. Stephen, when you're ready for me to have you share the screen, just let me know. Right now they see you and they see me. Hey, Cindy, make sure you mute yourselves as well, folks. Thank you.
All right. Yeah. What's up, Sal? Thanks, man. Great intro. It's been great to meet you over the last year or so and see what you're up to and everything like that. So as Sal said, I'm Stephen Nagy. So I live right here in South Florida with, I believe a lot of you are here as well. I'm up in Hobe Sound, actually. So a little further north maybe, but been in real estate investing for about 15 years now. Out of college, I was a financial advisor. I worked with Ameriprise Financial, fully licensed, Series 766, all that good stuff. And long story short, I attended a real estate investment seminar, and it made a lot of sense to me. Just the idea of being able to kind of control my wealth and control my life really through entrepreneurship, through real estate investing, and everything that brings along. So long story short, after about a year and a half of getting into real estate, doing some wholesaling and getting into a couple flips, I decided to make the full-time move to get into it full-time and let all my financial planning career and licenses and everything go. So over the years, I've had the opportunity to do a lot of deals, do a lot in real estate. I'm still a licensed realtor to this day. And, but over the years, I've also kind of learned what I like to do. So I've started several different businesses, everything from swimming pool cleaning businesses that I've sold to consulting businesses to being involved in private funds and things of that nature. And so I've really learned what I like in life, and what I really enjoy in life is teaching and training and working with my clients. So I've had opportunities to travel all across the country. I've spoke on hundreds of stages, worked with thousands of students all across the country. But what we're going to be concentrating on today is what we call becoming your own bank, or the brand, the Money Multiplier, and something called the infinite banking concept. Now, I'm going to respect everyone's time today. I have to get off here right at 1 o'clock. So we have about 45 minutes. So I'm going to hit about an hour and a half worth of information in about 45 minutes. So we're going to go kind of quick. I'll try and save a little bit of time for question and answer. If you want to put it in the chat box, I can answer the questions as we go, or even Sal can respond to them. So in 2019, I launched a seminar company teaching real estate investment education. We started traveling the country, myself and my business partner, Chris Noggle. In 2020, COVID shut the world down, including our traveling seminar business. So we pivoted and really learned how to do things online. So for the past 3 going on 4 years now, we've gotten really good at training and working with students all across the country virtually. Now we have gotten back to doing live events. So we hold masterminds, we hold in-person workshops. I got a Money Tank event coming up next weekend in Salt Lake City, Utah. So our entire thing is I've evolved from just doing real estate education and kind of combined it with my past career of being a financial advisor. So what we do today is we teach people how to take back control of their money and solve your money problem. And we do that through various strategies, through alternative investing, through real estate investing. So we talk a lot about money and opportunity. So we talk about things like self-directed retirement accounts. We talk about leverage. We talk about tapping into equity. We talk about constantly having money moving at all times, because there's two laws to wealth, right? Number one, compounding interest. Compounding interest is the cornerstone, is the foundation of everything that I'm going to be teaching you right now today. So when it comes to becoming your own bank, we're going to take advantage of something called compounding interest, uninterrupted compounding interest. So I'll show you exactly how that works right now today. And then the second most important part is keeping money moving, because what I've learned is money sitting still is doing nothing for you. It's losing, actually, especially when we see inflation like we've had 6, 7, 8, 9% over the last 2 years. Inflation just destroys wealth. And so we look at, how do we eliminate inflation? How do we eliminate things like taxes, paying more in taxes? How do we reduce our tax burden? How do we reduce volatility when it comes to building wealth? And these are all strategies. So what we're going to focus on today is becoming the 5%. So what I've learned is you can teach 100 people a strategy. It's about 5% of people are actually going to take action on it, are going to be open to learning it and taking action. And as Sal said when he opened up, he's had about 100 and some people register from this event between LinkedIn and his various networks when it comes to real estate. And right now, I think we got about 5% of that number on here right now. So it goes to show you that that 5% holds true no matter what. In fact, the Social Security Administration tells us the same thing. If you take 100 people in the United States today, only about 5 out of those 100 are going to be financially secure in retirement to retire the lifestyle that they want to retire in. I saw it personally as a financial advisor, and over the last 15 years, I've seen it over and over and over again with clients. And to me, the United States is the greatest country in the world, more opportunity. If you guys are in real estate, you're realtors, you're investors, you understand this better than most. You've gone out there, you've taken control, you're learning or understand entrepreneurship, and you're putting that American dream into action. That's a beautiful thing. And unfortunately, so many people still fail when it comes to achieving their financial goals and being able to enjoy life throughout retirement, and really just enjoy life every single day that we're alive. I mean, every morning we wake up should be a blessing. And so that's kind of how I live my life. And what I've dedicated it to is learning new strategies, applying those strategies, and helping other people learn them as well. So like I said before, taxes, inflation, and volatility, these are what I call tax killers or wealth killers. And we won't get too much into it, but I'm going to cover these 3 today. How do we eliminate these from our lives using this infinite banking concept? The bottom 3 right here are stuff that you guys are going to have to work on yourselves. So this is all has to do with mindset. And I'm sure Sal could probably train on this for days. Mindset is everything, because what I'm going to teach you today, right now, goes against what you've probably been taught your entire life. And so you're going to have to do a little mindset change to really pick up on what Sal and I are teaching you guys here today. And this is one of my favorite quotes right here. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. So just think about that for just a second, and think about that as we go today, and people that you know in your life. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. And we'll talk about some examples as we go throughout that, all right? So a couple of people I want to introduce you to, Brent Kessler. So Brent is the founder and broker for the Money Multiplier. The Money Multiplier is the brand that Sal and I are sharing with you today that teaches the infinite banking concept. Now, and like I mentioned before, Chris Noggle, my business partner, all this stuff that we do. Now, let me ask you guys a simple question here. When we talk about the Money Multiplier, we talk about becoming your own bank, BYOB. What does that mean? And let me just give you a couple examples real fast, okay? So why would you want to be a bank? Do banks know how to make money? Are banks good with money? Right? That's what they're in the business of. And I'm going to talk about banks, what they do, how banks take advantage of us, and why we want to become our own bank today. But let me just give you this example. If you could have a bank, okay, and that bank provided you an ATM machine, and that ATM machine, you could go and you could put money into that thing. Let's say you put $10,000 into that ATM machine, and the very next day, you could go pull $13,000 out of that ATM machine. And then the next year, you go deposit $10,000 into that ATM machine. And the very next day, you can pull $15,000 out of it. And the very next year, you go put 10,000 more in. And now you can pull $17,000 more out. And every single year, guaranteed for the rest of your life, you could go to that ATM machine, deposit money in, and pull more money, exponentially more every single year for the rest of your life out of that thing. How many of you would want to have a bank and have an ATM machine that does that for you? Anybody on here?
I
Just
do,
shake
but
your head. I can't see you.
do. Hey, Steve, I do, but you know what? That's too good to be true.
Okay. Right. Well, I'm going to show you exactly, and I'll show you all this stuff right now. We're going to go through it. So that's exactly. Now, if you wanted one of those ATM machines, how many of you would want multiple of those ATM machines? Want more than one of those? Right? Absolutely. So that's exactly what I'm going to show you. Or let me give you one other example, I guess. You know, when it comes to banks, like, what do you guys know what banks invest in? Let me ask that. So banks put their money in two places. Over 90% of banks' M1 money supply, meaning their profits, their money that they use on a daily basis, 90% of it goes into two places. Number one is real estate. So banks buy real estate. If you think about where banks are located, they're the most beautiful cities, the most beautiful buildings in the nicest cities across the world. I mean, the highest skyscrapers that are brand new are Bank of America and Wells Fargo and Morgan Stanley, and they're beautiful banks. Every street corner in the suburbs, in urban and rural America, there's banks. Banks buy real estate. That's what they do with their money. Banks also put their money in a second place outside of real estate. And banks are the largest purchasers of this vehicle in the entire world. Does anybody want to guess what that is? If you know, you know. Sal, I know you know. But I'm going to save that for just a second. I want you to think about that. Where are banks putting their money? And I'm going to come back to that in just 1 second. But for me to fully understand what banks do, let me just show you a simple strategy that banks do with people, all right? So let me ask you this question. Let's test your financial IQ real fast. So on the screen, how many of you think this? Can you make money earning 4% while paying 6%? What do you think? If you want, put it in the chat box. Yeah. What do you think? Yes or no? Can you make money earning 4% while paying 6%? Okay, Melissa and Cindy say yes. Cardia says yes. All right, cool. Okay, Tracy says no. All right. Okay, let me show you what this means. All right, let's use a car. Let's use an example of buying a car. Everybody's bought a car before. Most likely, all of us have financed a car before or bought one with cash. So we kind of get how this works. So let me use this as an example. Let's say you want to buy a car, $25,000, and you've been saving your money up. Okay, you got $25,000 saved up in your bank account. And you're like, all right, I hit 25,000. I'm ready to go buy this car for 25K. So you go on down to the bank and you say, hey, Mr. Banker, I'd like to withdraw $25,000 from my savings account. I've been saving up and I want to get that money out. What's the teller going to do? The teller's going to look at you kind of dumbfounded, and they're going to say, okay, hold on 1 minute. And they're going to go into the back room, and they're going to come back with a vice president of the bank. You know, the guy with the fancy suit on. They all got it. I actually got my little VP badge right here, VP of cash flow. But if you notice, banks have they're all vice presidents. I'll tell you why in just a second. So the vice president comes back over in his fancy suit. He says, hey, Stephen, listen, I understand you want to withdraw $25,000. Why is that? And you're like, well, it's my money, first off. So why are you asking me why? But nonetheless, they're required by law to ask you. And they're probably not going to have $25,000. Actually, just recently, a partner of mine had to pull out some money to pay contractors on a deal. It was like $22,000. He had to go to 5 different branch offices to get the cash. These banks don't have cash, but nonetheless. So 25. So the vice president says, well, listen, you're going to buy a car. That sounds cool, but let me make you an offer. So here's what we're going to do. Is we're going to put your money into a new savings account. This savings account is going to pay you 4% interest. Now, ironically, when I started doing this presentation 2 years ago, savings accounts were paying like 0.001% interest. Actually, today, American Express, Goldman Sachs, they're coming out with some above 4% savings accounts. So it's amazing how quickly things change also. But nonetheless, for this example, this bank's going to offer you a 4% savings account. And what the bank vice president says to you is, listen, Stephen, what we're going to do is we're going to allow you to keep your money in that savings account at 4%, that $25,000. And then what we're going to do is we're going to use that money in that savings account as collateral, and we're going to give you a loan so you can go purchase that car. So you think to yourself, all right, well, that's cool. Like 4% is pretty good in a savings account. Like it's risk-free, it's protected. So that sounds good. I can still go buy the car that I've been saving for while my money grows for me. And you say, okay, well, that sounds good, but what are you going to charge me to borrow the $25,000 to go buy a car? And the banker says, well, we're going to charge you 6%. And you say to the banker, you say, listen here, banker, I know that you think I'm a dummy. In fact, you have a whole bucket full of lollipops sitting on the counter right there. And what's the name on those lollipops? Everybody listening. Every bank in America has a bowl of lollipops. And what is the name of those lollipops? Tracy knows, dum-dums, right? So you're like, listen, I know you think I'm a dum-dum for coming in here and banking with you, but I am smart enough to know that I'm not going to pay you 6% while you're only giving me 4% on my money that's sitting there. And the banker says, no, you don't understand. So let me show you guys how this works, all right? So this is what happens. We're going to do a car note for 60 months. That's a typical 5-year car loan at 6%. So that $25,000 over 5 years at 6% in a car note at $483 a month is going to be about $29,000 at the end of the 5 years. However, what happens to our $25,000 over here in the savings account? Same amount of time, but at 4%. That money's actually going to grow to be just over $30,500. So if we would have listened to the banker, we actually would have made over $1,500 by paying 6% and only earning 4%. Now, why does that happen? And you guys can use financial calculators to make to check this math. But why this happens is the car note, what happens each month when you pay $483? That $25,000 balance diminishes. So each month it gets lower and lower and lower. So that 6% you're paying each year is actually on the lower and lower and lower balance. But what's going on over with the savings account? The $25,000 that's sitting in there that's growing at 4%. Well, that money's compounding. So the car note is a depreciating simple interest. The savings account is a compounding return. So that $25,000 each year compounds. So 4% might be 26,000. And then that 26 compounds by 4% to 28,000 to 30,000. So that's how we get to the larger number. So it's little things like this that we need to start understanding when it comes to simple versus compounding interest. And when it comes to the infinite banking concept that Sal and I are teaching you right now today, a lot of it is going to bank on it. So keep this in mind as we get going through this right now. And Sal, if anybody has any questions over there as we go, I know that was pretty simple, but if you can't answer it like in the chat box, just interrupt me and I'll hit it real fast, okay? All right, cool. All right, so what is the money multiplier method? What are we talking about here today? So it's going to consist of 3 different parts, and these are the 3 different areas I'm going to cover with you today. So number 1, we have what's called the machine. So this is the vehicle that this entire concept is built on. This is the product, so to say. The product's not nearly as important as the next 2 steps, but we'll talk about what the machine is here in just a second. Part number 2 of 3 is the marathon. Okay, so first off, this is not like a get-rich-quick scheme. This isn't like some kind of network marketing pitch or something like that. This is a financial concept and strategy that's been used for hundreds of years by some of the wealthiest families in America that I'm teaching you. So this is a proven concept that just maybe nobody shared with you before. We've been doing this for a very, very long time. So it's the marathon. So this is something that's going to take a few years to kind of get going, even though you're going to take full advantage of it immediately in day 1, it's going to take a few years to kind of really get it rolling. But once that happens, boom, it's amazing what it'll accomplish for you. And so we're going to talk about the concept and what that does for you right now today. And we're going to talk in 3 primary ways that this is going to help you. So number 1, let me ask you guys, number 1, does anybody on here have any debt by chance? Third-party debt? Maybe student loans, car notes, mortgages, credit cards. You know, one thing that I found is for a lot of people, when they start making money, especially good money, they tend to start spending a lot more. I'm okay with that. I'm not a Dave Ramsey guy that says save every penny. I enjoy a good time. I love traveling. I love buying things just as much as anybody else. But there's smart ways to do this. So if you found any debt, I'm going to show you how to pay off your debt a lot faster than otherwise possible while still building wealth. So I'll show you that in just a second. Number two, if anybody likes buying things, like I just mentioned, cars, boats, we're in South Florida, airplanes, major property, real estate, like anything like that, I'm going to show you how to get back. Let me ask you this. How would you like it if I could show you right now how to get back every single dollar for every car you'll ever buy, drive, and own in the future? You guys want to learn how to get back every single dollar for every car you'll ever buy? I'm going to show you that right now. All right. And then number three, this is where the fun part comes in with this strategy, building wealth. This is how you get to the third section of this, the millionaire. So once we eliminate the debt, once we're done buying things, or we have other cash flow where we're buying things and we have more money, that's when we start investing. So that's where the real estate investing component of this is where we can really start moving our money and keeping that money moving while we're taking advantage of uninterrupted, guaranteed tax-free compounding returns. And this is how we truly build wealth, create a legacy, and become the millionaire, not only millionaire, but multi-millionaire, because that's needed this day and age with everything that's going on in the world. All right, so that's exactly what we're going to get into right now. All right, so let's start with the machine. Let's start with the vehicle. What are we talking about right now? All right, so this entire machine, everything that we're going to do is built on a dividend-paying whole life insurance policy from a mutually owned insurance company. Okay, now stick with me. Sal, make sure nobody's logging off. I'm not here to sell you guys life insurance. Don't worry. When I first saw this, I was like, get out of here. All right. But once I saw what this is and why, it makes a lot of sense. All right. So let me just make a couple of clarifications real fast. Number one, this is not a whole life policy that you can go to policygenius.com, call an insurance company, a whole life insurance company, and have them do, your insurance guy in your local networking group, or your brother-in-law or whatever. We all know an insurance guy, right? This is not that. What we do is this, and this is all that the money multiplier does. This is all me and my team do. This is all Sal does when it comes to this infinite banking concept. But the money multiplier, this is all we do, is we specially design and engineer. So what we do is we take a whole life insurance policy and we basically butcher it. We murder it, so to say, and we destroy it, and we completely redesign it and build it specifically for this strategy for you to have full advantage. Now, for us to be able to do that, we have to find the right company. So we only deal with companies that have been in business for at least 120 years. They're mutually owned. They have the strongest financials. They pay strong dividends every single year without ever missing a year for 120 plus years. So it starts with the company and then allows us to design these things the right way. Now, to design it the right way, me as an insurance broker, I have to take a 60 to 90% commission hit to be able to design a policy this way. So 99% of insurance agents do not know how and are not willing to do policies this way. Because if you go to your guy in your local networking group or the guy that you know and say, hey, listen, I got this really cool strategy that's really going to help your clients, but you have to take a 90% pay cut to be able to do it. How many of you think they're going to be excited about that? Not many. But this is all we do. Okay. And there's a reason for that. So just understand this is very specially designed. You do come to Sal and me to have this done as well. Mass Mutual can work. Tracy, there's a few reasons we're not using Mass Mutual right now. But I do personally have a Mass policy. It's a great company. We also use One America, we use Lafayette Life, we use Guardian, Penn, SML. So we use a handful of companies. But again, it's very specially designed. So I just want to make that very, very clear. All right. Now, I asked you a question earlier. Where do banks put their money? Number one, real estate. Number two, anybody guess it? Whole life insurance. It's something called BOLI, bank-owned life insurance. And you guys can look this up later on. Write this stuff down and go Google it later. BOLI, bank-owned life insurance. Banks are the #1 purchasers of whole life insurance in this country. Do banks know how to make money? Yes. Do we want to mimic what banks do? Yes. So does it make sense that we go out there to build wealth? Maybe we buy some real estate. Maybe we look at using life insurance this way. Absolutely. So that's exactly what we're going to get into right now. So that's the vehicle. But who are some other people that use these policies? So Jim Harbaugh in 2016 became the highest paid football coach in America. And a large portion of his pay was through deferred comp, alternative investment plans. Very, very similar to what we're talking about right now, using whole life insurance. That's exactly what they did for Jim Harbaugh. And it's becoming more and more prevalent for leaders, for CEOs, for executives, and for people like Jim, to be able to build in their comp plans. And we do stuff like this all the time with companies also. Number two, Joe Biden has 6 of these policies with masks. Why? They're protected. They're private. He doesn't have to disclose anything. Politicians love these things. It's another reason why we love them, because these laws are built when you know how to take advantage of them for us, by politicians. Why? Because they use them too. Makes sense, right? Number 3, Walt Disney. Disney World almost did not come to be because Walt was out of money. He actually tapped into whole life policies and used his policies to fund Disney while he was getting things going. And I have lots of stories like that. Pampered Chef with Doris Christopher. Again, you guys can look this up. I'm just going through it. Ray Kroc, McDonald's tapped into his life insurance. These people all use life insurance to fund their startups, as well as some of the wealthiest families, the JPs, the Morgans. A really good book. What would the Rockefellers do? The Vanderbilts, the Chases, the list goes on and on. I just wanted to give you a few examples. Again, this is not a new strategy. It's nothing that I came up with. It blew my mind when I learned about it in 2019. I bought a bunch of it. I've been using it now for several years, and I've helped thousands of clients now in all 50 states start. And I've yet to have a single person complain to me that what I told them was not true. I'm over 1,000 clients I've helped now. Not a single person has told me that what I shared was not true. So it's a beautiful thing, and it's amazing. And so let's get into this a little bit. All right. So again, to understand this concept, we really got to understand what banks are doing. So, and this gets into what you're going to start doing to build wealth. So that third phrase. So I want to talk a little bit about what we call spreads. So what do banks do? Let's say you go out and you do a real estate flip, or you sell a multi-million-dollar house, and you have a nice $100,000 paycheck, okay, commission, maybe a profit on a flip that you do, but you got $100,000. So what most people do is they just go down to their bank and they deposit it in their savings account or their business account. All right. Well, the bank takes that money, and the bank doesn't just, put it in a box and put your name on it and wait for you to come get it. Right. We all know that. Banks immediately take that money, and what do they do with it? They start making that money in motion. They start lending that money out. So what do banks do? Well, people go to banks for things like mortgages. So they'll go to the bank, and so let's say somebody needs to buy a house. They go to the bank, they apply for a mortgage. The mortgage takes the $100,000 you just lent, you just deposited at their bank, and they lend it to the homeowner. The homeowner takes it, they give it to the seller. What does the seller then do with that money? They put it right back in the bank. The bank takes that money. Now that you own a house, you got to buy a new car for the garage. So then you go down to the bank and you do a car note. You take that money, you give it to the dealer. The dealer takes the money and puts it right back in the bank. Now you got to remodel that house. Same thing. Maybe you racked up some debt over the years. Now you got to do a debt consolidation loan. Same exact thing. So what the banks do is they take your money and they start moving it and making money. They make what's called a spread. So how much spread did they make here? All right. Well, if they're paying you 4% in a savings account, and they're lending the money at 7% on a mortgage, they just made a 3% spread. Same thing with the car. They make a 4% spread.
This is a chat question.
Go ahead.
This is a chat answer. No, let's see if they can come up with the answer, because it's a good one.
Yeah. So at the end of the day, and you guys put this in the chat box, at the end of the day, the debt consolidation was 8%. All right. So if we add all this up, if we're making 4% and the bank's making 20%, how much spread did the banks just make off of our money? How much did the banks just make off of that $100,000 that we deposited at the bank? Okay. Cindy says 16. Cardia says 16. Tracy says 16. Yeah, that's what you would think, right? Percent. But think about this for a second. If they're paying us 4% and they're making 20%, how much did they really just make off of our money? 5 times the amount, or 500%, right? 4% to 20% is 5 times, 500%. In fact, this is more homework you can do. Go to this website later on. Go to BauerFinancial.com and just kind of browse around a little bit. BauerFinancial.com is a research agency for banks. That's what they do. And they tell us that banks make between 400 and 1,300% off of money that we deposit and leave there. So I asked this earlier, I'll ask it again. Why do you want to continue to make the banks wealthy instead of making you and your family wealthy? Stop letting the banks take advantage of you and start taking advantage of the banks. Are you okay with that? And I'll show you exactly right now how we're going to start doing that. And we're going to start doing that by paying ourselves first. Because are you important? I saw you guys' pictures on here earlier. Those of you that videos on, you look like beautiful people. You're important. One of the lessons I learned in life, like you got to make yourself important. All right. So let me show you how most people, the 95%, tend to spend money. So on average, every dollar that you earn in this country, on average, Americans, every dollar that they earn in this country, 20%, 20 cents of every dollar is spent on an automobile. This is on average, okay? Might vary a little bit, but on average, about 20 cents of every dollar is spent on an automobile. About 30 cents of every dollar is spent on housing. About 40 cents of every dollar is spent on everything else. So food or kids, travel, entertainment, whatever the case might be. So that leaves the average American, after everything's said and done, with 10 cents of every dollar they earn will go into savings. But in the real world, what typically happens? Throughout the month, emergencies happen. Things pop up. Oh, my child has another project that's due, or another field trip, or another whatever. Those of you with kids know what I'm talking about. Another sport that he needs a new baseball bat for. Oh, you got to have the best baseball bat. It's $400 nowadays. Anyways, right? So, you know, after everything, so what happens is those savings actually really diminish. And I do 4 or 5 live webinars. They're free every single week. And we really get into this stuff on some of those other webinars. And so we'll look at patterns, we'll look at history, we'll look at cycles. And it's really interesting to study what happened during COVID. Savings in this country went way up and credit card usage went way down. But last year, what started to happen? Savings started really falling hard and credit card usage started skyrocketing and right now it's like starting to hit record levels right now. So we're starting to see a real negative thing going on that's going to cause a ripple down effect in the entire economy. And I'm not going to get into that right now. Like I said, we could talk about that on other webinars. So in reality, this 10% savings is really becoming smaller and smaller and smaller every single day right now for the average American. But let me show you how we can completely reverse this by making yourself important and paying yourself first. So let's do what the 5% do. Let's do what the wealthy do, okay? So let me show you how this works. So instead of paying everybody else everything first and keeping what's left over, let's pay ourselves first, okay? So out of that dollar, let's take 10% and let's put that into our savings. Let's put that into our bank. And now by doing that, it's going to allow us to use our savings as a bank to buy what we need and stop bleeding to everybody else. So let me show you what I mean by that. All right. So of the 20 cents of every dollar that goes to automobiles, on average, 5 cents of that 20 cents goes to interest. So that's just money that you're bleeding away to somebody else, a third-party debtor, another bank, whether it's Honda, BMW, Range Rover, whatever. You're bleeding that to somebody else. So what we're going to do is, instead of bleeding that 5 cents of every dollar to somebody else, by paying ourselves first and using our bank, we're going to be able to pay ourselves that interest. Okay, and I'll show you how we do this in just a second. But watch what this happens when you start applying this to your own personal life. Well, that 5 cents of every dollar is going to make a huge difference, because if that 5 cents is not going to somebody else's bank and it's now coming back to my bank, what did that just do to my annual savings? It increased my annual savings by 50%, 50%. Because if I was saving 10 cents prior and now I'm saving 15 cents, that's a 50% increase. Over time, that's really going to start to compound. And it just doesn't work for automobiles. How about housing? You guys are all in real estate, right? Do you know, out of the 30 cents that's spent on housing, on average, 25 cents of that 30 cents goes to interest? Why so much? And again, you all know real estate, because of amortization schedules. because of how we pay interest on mortgages. What happens in the first 7 to 10 years? About 90%, 80 to 90% of interest is paid on a 30-year fixed mortgage in the first 7 to 10 years. On average, how often do Americans either move or refinance their home? On average, every 7 years. The banks don't care. The banks are getting all their interest up front. That's why they do teaser rates. That's where they're constantly adjusting. Okay, that's why they have due on sale clauses to make you restart that thing every single time so they can get their money and then they don't care what happens. All right. So while we're at it, let's go ahead and take that 25 cents that we're bleeding to the banks. Let's keep that in our financial family. Is that okay with everybody? And then of the 40 cents that goes to everything else, on average, 5 cents of that. So while we're at it, let's go ahead and recapture that money as well. So think about it. We didn't do anything different here. We paid ourselves first and we used our money to do this instead of bleeding that money. I'll show you how we do it in just a second. By making that one change where our money goes first, it changes everything for you. Does that make sense? All right. So let's show you how to get back every single dollar for every car you'll ever buy, drive, and own in the future. Ready for this? All right. So this is a look under the hood. This is what we call the machine. This is that whole life insurance policy that I was telling you about over here on the right. So the right side, and I'll show you some real world illustrations at the end here. But this is a what's called a life insurance illustration. And so you have the policy year, you have the age of the individual, you have the premiums that we call deposits. So the amount of money that goes into the policy. And then the rest of this I'll show you in just a second when it comes to buying the car. And then over on the right-hand side over here, we have what's called the death benefit, which goes to you upon your passing, which we're not doing this for the death benefit, but it's nice to have. All right. So check this out. So a couple things I want to mention. First off, the premiums that go into this policy. What I want you to start, again, a lot of this is mindset. So from this point forward, I want you to think of the premiums that go into this policy as deposits going into your banking system. Why do we want to do that? Because it's mindset. When you think of a premium, you think of like a bill. It's a negative. It's something that I have to do. But when you think of a deposit, you know, you make $30,000 commission, you make $60,000 on a flip, you make $10,000 on a wholesale deal, whatever. Well, you're excited when you get that check to go deposit it into your business bank account. Why would you not be excited about depositing money into your own banking system? You will be. But I want you to start thinking of that right now. The money going into this policy is now deposits going into your new banking system, all right? And the amount of those deposits is 100% up to you. It's up to you. We'll talk more about that, but you decide how much you want to put in. $500 a month, $10,000 a year, $100,000 a year, $1 million a year. It's completely up to you. We'll talk about that. Number 2, age doesn't matter. We do these for babies. We do these for kids in their 20s. We do these for teens. We do these for 30s, 40s, 50s, 60s, 70s, even people in their 70s. Now, if you do have terrible health and you know you can't get life insurance, maybe you're in your later 70s and we're kind of on the borderline, it still doesn't matter because we do have solutions for that. Sal and I can talk to you about how we can use somebody else's body. You can still own this, be the bank, and just have it on somebody else's life. So we have solutions for that. And number 3, I mentioned the death benefit. It's not really important, but when it comes to legacy, those of you that do have families and kind of want to start thinking generational wealth, well, this will start. And it seems to be for me, like in my 30s, I didn't really give a crap about death benefit and stuff like that. But as I get a little bit older, I have a son now and a family, and like that death benefit part, it seems every year, I just turned 40 years old in January this year. It seems like every year I start to think about that side a little bit more and more, but nonetheless, again, that's not why we're doing this, but it is nice to have that. All right, so let's talk about buying this car. So what does this look like? All right, so when this individual started this policy, they decided they wanted to put $10,000 a year into it. All right, so they started putting $10,000 a year in. Over here, the cash value in the money multiplier account. The cash value is the amount of money that you have available to use as you put money into the policy. So you'll notice the first year they put 10,000 in, they had 5,800 available. excuse me, the second year they put 10 in, they have 12,000 available, and you'll see how that grows each year. Now, today's policies, we can really get a lot higher cash value, a lot faster, where you can get access to like 70 to 90+% within the first 30 days. This is a little bit older. And plus we like to kind of, under promise and over deliver. So if this works this good with this policy, imagine what this would look like if we design it for even higher cash for you. Okay. And before I get into this, I just want to hit Jackie's question. She said, isn't there a Roth where you can self-direct, same concept? And Jackie, the answer is no. So I'm also a self-directed IRA expert. I've been working with retirement accounts for many, many, many years. So IRAs are what are called, and I'm glad you brought this up. So IRAs are what are called qualified funds. So a 401k, an IRA, a SEP, a simple, and those can be a traditional IRA or a Roth IRA. Traditional means simply it's tax deferred growth. A Roth IRA is tax-free growth. But that money's locked up until you're 59 and a half years old. If you pull it out early, you're going to pay a 10% penalty, and you can't touch that money for many, many years. What I'm showing you right now today is a place to put your money, get uninterrupted tax-free compounding growth, and simultaneously, we can use that money right now today also to be able to use it to invest and grow wealth even more. So we got the money building and compounding for the future retirement and other generations over here while we're still using it today. So, and these whole life policies are what you're going to use with your non-qualified money. So we don't want to cross stream. So all your qualified money, yes, we want to self-direct that money, keep it in retirement accounts. All our non-qualified money, we want to run through these policies. And this will make a lot more sense when we get to the end of this and you see some examples. But great question, Jackie. I'm glad you hit that real fast. Also, yeah, tons of limits also on qualified accounts. All right. So in the third year of this policy, back to this policy, in the third year of this policy, this individual wanted to make a car purchase for $25,000. So they pull $25,000 out of their policy and they go buy a car. Now, if you were to go down to BMW or Honda and purchase a vehicle, they're going to give you a car note. What are you going to do with that car note? You're going to pay that car note every single month for the next 5, 6, 7 years, whatever the car note is, right? Every single month. So let me ask you this. If you go buy a car and you take the money from your bank, remember, this is your new banking system, your bank, and you take the money from your banking system, is it okay if you pay yourself back monthly? Absolutely, right? So we call this being an honest banker. You want to pay yourself back, you want to treat your money just like you would treat the bank's money. So we're going to create a plan for you to pay yourself back. And I can get into how we do that on the phone and what that looks like. I don't have time to get into it right now, but essentially we're going to create a car note for ourselves and we're going to pay ourselves back with interest, just like we would to the bank. All right. So that's exactly what we do. Over the next 5 years, we pay ourselves back with interest. So we pay ourselves back a total of $30,000. So at the end of 7 years, we put $70,000 in premium deposits in. We took $25,000 out. We recaptured $30,000 back into our banking system for a total of $75,000. So right here, this number 67,881. That's the amount that's in our banking system available to us right now today. So I put 75,000 in, I have $68,000 available, and I have a $25,000 car paid for free and clear sitting in my driveway. I just recaptured 91 cents of every dollar that I paid to buy that car. However, I told you guys a second ago, I'd show you how to recapture all of the money, not just 91%. So let's keep going. Because does this banking system, does this whole life policy end at year 7? No, it's a whole life policy. It's going to compound and grow for you. This column right here, the cash value, that's going to compound and grow for you every year for the rest of your life. Uninterrupted, guaranteed. So let me show you how that looks like. Now, for the sake of argument, in this example, we're going to stop putting premium deposits in after the 7th year. Now, in reality, you would never want to do this. And when I show you some illustrations in a second, you'll see why, because the more you put in, the higher returns you're going to get and the more growth and efficiency. But just for this example, what if we don't put another dime ever back into this thing? What happens? All right. Well, in the 8th year, we buy another car. We do the same thing over the next 5 years. We pay ourselves back. All right. So we put no new money into it. We took $25,000 out. We recaptured 30,000 of it. So we net injected $5,000 more. But how much did our policy grow from $67,000 to $91,000? It grew by $23,500. We put no more money into it except for the $5,000 recaptured interest, but it grew by $23,500. We now have $91,000 sitting in our banking system. We have $50,000 worth of vehicles sitting in our driveway, free and clear. Would you all agree with me that we have now recaptured every single dollar for those 2 cars? And what are we now able to do? We're able to now go out there and do it again. And if this works for cars, what else can this work for? Houses, boats, airplanes? You tell me what you want to recapture the money for back into your life. Now, there are 3 rules that we need to follow to make this concept work. Number 1, always pay yourself first. Remember, I said that before. You're important. Rule number 1, always pay yourself first. Rule number 2, always pay yourself with interest.
Trying to get that transfer to a buyer, and the buyer's
Now,
like,
if you
well,
control, just
what's
mute
my-
whoever that is, if you don't mind. So always pay yourself back with interest. And rule number 3, always recycle and recapture your money. And what I mean by that is be an honest banker. But here's the difference: is if I go buy a BMW today, and in 3 years from now I hit hard financial times and I can't make that BMW payment, what's going to happen to that BMW? A tow truck's going to show up and they're going to repossess and take that thing away from me. But if I'm the bank, what's going to happen? Well, I'm going to go to the mirror and I'm going to say, hey, Steven, listen, I fell onto some hard economic times. I can't make my car payment for a few months. Do you mind if you cut me a break? And I'm going to look at myself back in the mirror and I'm going to say, you know what, Steven, you're a pretty good guy. I really like you. So you take as long as you need. Just start paying me back whenever you get a chance to. And I joke about that. But why? Because you are in control. How you recapture that money is 100% up to you, to the point of you don't ever have to repay yourself. Because when you take money out of that policy, all that's actually happening is you're borrowing it from the insurance company's general account. The insurance company is using your policy as collateral against the death benefit. So at the end of the day, the insurance company doesn't care if you pay them back or not. But to do the infinite banking concept and be your own bank, we're always going to encourage you to be an honest banker. But at the end of the day, you are in control. I hope that makes sense, everybody. All right. So let's keep rolling with this. I want to give the debt example. All right, so this was a chiropractor that made great money, but he also liked to buy things. So he had a boat, he ran up some credit card debt, he had a BMW, he had a condo on the lake, and he had his home. This was about 10, 12 years ago. It's an older example now, but it's a beautiful, it's perfect to show again, under promise and over deliver. So we can do this even faster today with our new policies, but let me show you this. So this chiropractor was $478,000 in debt. He was paying $5,700 a month to third-party debtors, $69,000 a year going to other people. It was going to take him 19 years to pay off this debt if he did it as scheduled. So he said, listen, we can show you a better way using this banking system, using this whole life policy and the infinite banking concept to snowball this, pay it off a lot faster while still building wealth for the future. So check this out. What we did is we started a policy for this chiropractor, putting $25,000 a year into it. The first year he put $25,000 in, he had just under $15,000 available to pull back out to use. So what do we do with that $15,000? We pull it right out. As soon as we put that $25,000 in, within 30 days, we can pull 15 back out. We paid off the Discover, we paid off the Lowe's, and we paid off the Nordstrom, paid down the Nordstrom card. So we just eliminated the $161 and the $287 monthly payments, a total of $448 a month. We eliminated those. So now we have $5,329 going to third-party debtors. However, what are we going to do with that $448 a month now? That was going to Discover and Lowe's. Well, That $448 a month, instead of giving that money now to Discover and Lowe's, because we paid off those cards, we're going to keep paying that $448 a month, but we're going to pay it back to ourselves into our banking system. So we're going to teach you all, we're going to recommend you open up what's called a segregated bank account. So this segregated bank account is just a separate bank account that you can use where when you take the money from the policy, it goes into the segregated account. From there, we're going to show you where to deploy the money in the best way possible, the most efficient way possible to pay the debt off. In this case, we deployed the money to pay off the Discover, pay off the Lowe's, pay down the Nordstrom. Now that $448 a month, instead of going to them, goes back into our segregated account. So that way, what are we going to do with it in year 2? You guessed it. We're going to pay off more debt. So in year 2, we deposit $25,000 into the policy. Now in year 2, we have $16,500. Again, each year it's higher, remember? And we have $5,300 in recaptured payments. So that's the $448 a month over 12 months going into the segregated account. So we have a total of just under $22,000 to deploy to pay off more debt. Snowballing this. Bye-bye Nordstrom, bye-bye Wells Fargo, bye-bye private loan, and reduce the BMW. So now we have $3,800 going to third-party debtors, $1,900 a month going to our segregated account. Year 3, same thing, $48,000, pay off some more debt. All right, $2,100 going to third-party debtors, $3,600 coming back to us. Now, let me make sure you're following so far. How much do we put in? Okay, in the first 3 years, we put in $75,000 and we took out $55,000 to pay off debt. So how much do we still have within the policy? Put in the chat box. We put 75 in and pull 55 out. How much is still in there? Just want to make sure you guys are following. Cardia says 20,000. Any other guesses? All right, let me show you guys. Yep, Tracy knows it, $75,000. So I alluded to this earlier. When we take money out of the policy, we're not actually taking the money out. We're borrowing the money out of our policy from the insurance company's general account, and they're using our policy as collateral and the death benefit as collateral. Because remember, to them, they're going to pay that death benefit out no matter what. So what do they care if they pay it later or they give it to us now? Insurance company doesn't care. But what this allows us to do is by borrowing against the policy instead of taking money out of the policy, it allows all of that money, the entire $75,000, to do what? It allows that 75 to remain in there, compounding, uninterrupted, tax-free, guaranteed every year for the rest of your life. Uninterrupted compounding interest is the 8th wonder of the world, according to Albert Einstein. So that's exactly what we're taking advantage of. So I love it. Good job, Tracy. All right. So year 4, same thing. Okay. Year 5, same thing. Now something does happen in year 6 before we finish this thing off. Year 6, the initial policy that we started at $25,000 a year, well, the chiropractor could no longer put 25 a year in. He could only put 10,000 a year in because of things called MEC rules and regulations. So the IRS actually regulates these policies. And so the IRS tells us, at a certain time, you have to reduce the amount of deposits going in so the policy doesn't do what's called MEC, which you don't want to happen, will make it taxable, which would never happen to you. I'm just explaining why this happens. However, the chiropractor loved this, what he was doing, and he wanted to do more of it, not less. So the chiropractor said, well, what do? I can only put 10,000 in. And so what we do is we show you how to start opening additional policies. So you can open more policies on yourself. This is what we call stacking policies to build your banking system. Whenever you have more money than will fit in your existing policy, it's time to open another policy. So you can open additional policies on yourself, on your spouse, on your kids, on your business partners. So this is how you start growing your banking system. And like Sal said in the chat, you get more banks or more ATM machines, as I mentioned earlier. So very good. So you'll notice in the first policy, he puts 10,000 in, he can pull 13,000 back out. By the way, that's a 30% cash on cash return that year. not bad having an ATM machine. You go put 10 in and you can pull 30% more money out the next day. And they started a second policy. Now, again, it starts over. So the 25 goes in. He's a little bit behind for the first few years where he has 14,000 he could pull back out. So what do? We now have enough money to pay off all the debt. So in 6 years, we were able to eliminate all third-party debt that otherwise would have taken 19 years. We now have all this money that's in his policies compounding uninterrupted for the rest of his life. And what is this chiropractor going to do with that $5,700 a month that he was giving to third-party debtors? Yep, he's going to continue paying it back to himself, putting it back into the policies so he can use them over and over again for future purchases, for future investing, and for future wealth creation. Plain and simple. And we're going to do this for you. So if anybody has debt, the money multiplier, once you have a policy, we have what's called our mapping implementation team. And you're going to be assigned a mapping implementation expert specialist. And they're going to sit down if you have debts and they're going to go through all of your debts. So start getting together the balances, the monthly payments, the interest rates. We'll do a cash flow analysis with you. We'll take your policy and we'll create that exact same plan for you. And then we'll meet with you every 3 to 4 months to update it. How are things going? Tweak it, change the numbers if we need to, ask you how it's going moving forward. And we do all of this, no charge. Okay. So I said before, if you want to do this, it's built on a whole life policy. You come to us to do that. That's how we get paid. It's a reduced commission, but by us getting paid directly from the insurance company, we don't charge our clients a dime. So from the initial consultations to designing the policy and making sure it fits your goals, to afterwards for years and years and years to come, to supporting you and helping you use this and creating these plans, you'll never pay us a dollar for any of that. It's just part of being a client with Sal, myself, and the money multiplier. All right, awesome. I like to call it my financial GPS. It's what I've used for years and years and years, but mapping is another way of looking at it for sure. All right, cool. All right. Now I do only have a couple minutes left, and this is usually everyone's favorite topic, the millionaire. So I just want to show you guys a couple examples of this real fast. So these are things that I currently am doing. I do a lot of real estate. I have a private fund right now. We're doing commercial stuff in. I do a lot of private money lending now. I'm not doing a lot of active flips or anything. Doing some rentals, but I don't need active flips. It's more lending on the passive side because I'm so focused on coaching and training and everything I'm doing with this. I have multiple businesses. We just bought another one last year. But this is all stuff I'm using my policies for. I actually just bought some forklifts that I'm flipping that had unbelievable returns. So always looking for opportunities. These are things that we share with our network. So if you like what we're sharing with you guys, we definitely want you to follow along. I'm gonna share this with you. I'm gonna go back and show you one more example. And then what I'm gonna do is invite all of you to connect on the phone. So we can talk more about your personal situation, answer any questions you have, and see if we can help you get started. So let me just put that on the screen real fast. So if you would like to receive a couple free books and get access to my calendar, just go over to this website that's on the screen. I put it in the chat box too. or just go to nagyleadership.com. Either way, nagyleadership.com is my link tree with all the different things on it. This Money School REI also has all the books and everything. It's like a funnel you can get into. Or Sal, if you want to share your contact information, everybody connect with us that way. I do have to hop on another webinar in just a second. If you'd like to continue learning more right now, you can go to that site right there and register. It's a free webinar we do every single Wednesday at 1 p.m. Eastern called Wealth Webinars. And every week we talk about different wealth creating strategies. It just happens to be that today we are going to talk about infinite banking concept. So I have one of my money mentors coming on. His name is Craig. He's a little bit newer, but he's doing some really cool examples of using real estate and using private money lending to grow wealth using the infinite banking concept. So what I typically would share with you right now in the millionaire section, I'm going to talk about on this next webinar. So maybe just connect with us over there, that bottom link, the moneyschoolrei.com/free-downloads and hop on that. Otherwise, what we can do is just let's get on a phone call and we can talk through it. Or Sal, maybe we want to do it in a couple weeks if everybody wants. I'm happy to come back and we could get into a little bit more advanced and
Sure.
get into this a little bit more.
Let me say
I
that-
saw Jackie's question: does EXP vet you? If she's talking about me, I personally am not in EXP, but I am friends with some very high up with people in EXP. I've met with regional vice presidents. I am very familiar with the company, and I'm very familiar with several brokers in the Eastern Florida area that are in EXP. I do business with a ton of people in EXP. So I don't know if the actual company per
Yeah.
se is vetted myself, but
Let-
Sal,
let-
I know,
I can
is
only
very
answer it
involved.
this way. You know, we are licensed individuals here that we're regulated and overseen by the Division of Insurance here in every state that we work in. So we're vetted that way. Everything that we're talking about is not really endorsed or programmed by any brokerage at all. This is all individual based. EXP, Keller Williams cannot stop anyone from really doing what they need to do for the benefit of themselves. So it's not an endorsed product or program. So I see no reason why EXP or anybody would need to vet your decisions or us. If that doesn't make sense, we could talk more about that.
Yeah, I mean, just so everybody knows, I'm a licensed realtor in the state of Florida. I'm licensed in insurance in all 50 states. I've been doing this for a very, very long time. So
Yep, you are.
here's
And-
my personal cell phone. Also, if anybody wants to text me or connect that way.
Yep.
Um,
So by the way, I want to add this, that people that are interested, and I know people are, they just need to learn more about it, and they can always reach out to Stephen, myself. Obviously, it's easier to find me through EXP Workplace or people that already know me and linked up to me. Easy to find me, but what you're gonna get here is two for the price of one, because you're not only going to get Stephen, you're gonna get me and Stephen, both of us, to help you along the way. And I think that's something you need to know. One other thing I want to add about
hey, Sal, real fast. Sorry. Let me just say one more thing and then I'll hop off and I'll let you close it down. What we can do is if you want to put another one of these together in a few weeks, if you guys are interested, just let Sal know. What we can do is we can go through the millionaire portion of this. All right.
Yeah.
And we'll get into these illustrations where, I mean, you'll be blown away at the returns on these things and how we use this money to funnel it through things like private money loans and use it in real estate investing. We do a lot of something called the Private Money Club. So we can definitely go through that and how we can help there. And I'll show you, so this is one example I always use, and I can get into the numbers on this, but I mean, I do a lot of private money lending. So if I lend from my policy, I'll make let me show you this. So instead of a 12% return annually on a private money loan, I show you how we can do I get to use the exact same money, exact same time, but instead of making 12%, I'll make 44%. And the only difference is where my money goes first, flowing it through this policy. So I would love to get into more advanced stuff with everybody. So maybe you can arrange that, Sal, and I'll let you do that. But I really appreciate everybody allowing me to come on and appreciate your time today. Sal, I'll let you close it down, get them your info. If you guys want, let's do this again in a couple weeks. But thanks very much, Sal. Appreciate you. I'll talk to you later on.
I'm going to catch you on the other show that you're doing.
All right, awesome, guys. We'll see you soon. Thank you.
Start without me, but very quickly, I have a
Thanks,
word.
Brittany.
All of you, thank you for being here today. We hope that we shared some valuable information to you. This information is not a secret. It's meant to be shared and for you, for the benefit of you and your family and your lives. One thing I'll say about this debt acceleration, and I'll wrap it up there. There are many companies out there that proclaim to be able to rapidly accelerate the debt and pay it down very, very quickly, charging $2,000 to be able to join them, which is an MLM system. Please stay away from them. There's no reason to be buying any program and paying for anything like this. Doing something like this is not a cost. You pay for nothing. You actually make a profit doing this. No, it's hard to believe. Please reach out to me. You can find me on Workplace. You can find me on LinkedIn. If you already have my email, just reach out to me. I will try to reach out to everyone who has been on here today just to get your feedback and answer any other questions that you may have. So thank you so much. And we look forward to chatting with you soon, answering your questions. Have a great day, everyone. See you again real soon.